Hello and welcome back to the MicroLearning Institute for a short tutorial on the fundamental principles of IAS 40 investment property. An investment property is property held by the owner to earn rentals or for capital appreciation or both. Examples of investment property include land held for long-term capital appreciation, also land held for undetermined future use, as well as buildings leased out under an operating lease. Additionally, vacant buildings to be leased out under an operating lease, as well as property that is being constructed or developed for future use as investment property. IAS 40 excludes the following types of properties. Firstly, property held for use in the production or supply of goods or services or for administration purposes. This type of property is dealt with under IAS 16, Property, Plant and Equipment. Secondly, IAS 40 excludes property held for sale in the ordinary course of business or in the process of construction or development for such sale. These kind of properties are handled under IAS 2, Inventories. IAS 40 also excludes property being constructed or developed on behalf of third parties. These type of properties are addressed under IAS 11, Construction Contracts. Number 4, IAS 40 excludes owner-occupied property. Again, these are handled under IAS 16, Property, Plant and Equipment. Owner-occupied property includes property held for future use as owner-occupied property, property held for future development and subsequent use as owner-occupied property, and property occupied by employees and owner-occupied property awaiting disposal. Lastly, number 5, IAS 40 excludes property leased to another entity under a finance lease. Investment property should be recognized as an asset when it is probable that 1. The future economic benefits that are associated with the property will flow to the entity, and 2. The cost of the property can be reliably measured. Investment property is initially measured at cost, including transaction costs. Such costs should not include start-up costs, abnormal waste, or initial operating losses incurred before the investment property achieves the planned level of occupancy. With regard to measurement, IAS 40 permits entities to choose between two models: 1. A fair value model, and 2. A cost model. One measurement method must be adopted for all of an entity's investment property. Change is permitted only if this results in a more appropriate presentation. With the fair value model, investment property is remeasured at fair value, which is the amount for which the property could be exchanged between knowledgeable, willing parties in an arm's length transaction. Gains or losses arising from changes in the fair value of investment property must be included in net profit or loss for the period in which the gain or loss arises. Alternatively, using the cost model, after initial recognition, investment property is accounted for in accordance with the cost model as set out in IAS 16, Property, Plant and Equipment. Cost less accumulated depreciation and less accumulated impairment losses. Transfers to or from investment property should only be made when there is a change in use. For a transfer from investment property carried at fair value to owner-occupied property or inventories, the fair value at the change of use is the cost of the property under its new classification. For a transfer from owner-occupied property to investment property carried at fair value, IAS 16 should be applied up to the date of reclassification, and any difference arising between the carrying amount under IAS 16 and the fair value at that date is dealt with as a revaluation under IAS 16. For a transfer from inventories to investment property at fair value, any difference between the fair value at the date of transfer and its previous carrying amount should be recognized in profit and loss. When an entity completes construction or development of an investment property that will be carried at fair value, any difference between the fair value at the date of transfer and the previous carrying amount should be recognised in profit and loss. When an entity uses the cost model for investment property, transfers between categories do not change the carrying amount of the property transferred, and they do not change the cost of the property for measurement or disclosure purposes. An investment property should be derecognized on disposal, or when the investment property is permanently withdrawn from use and no future economic benefits are expected from its disposal. The gain or loss on disposal should be calculated as the difference between the net disposal proceeds and the carrying amount of the asset, and should be recognized as income or expense in the income statement. Thank you for visiting the MicroLearning Institute and for watching this short tutorial on the fundamental principles of IAS 40 investment property.